How do I balance the risks I take with the returns that I may get? Hi, I'm Bruce Williamson. I'm the Chief Investment Officer at Imara Asset Management South Africa. Today I want to talk to you about what risk is. In investment circles, probably risk and return are the two biggest and most spoken about concepts. Typically, clever people look at risk and try and analyze it. And what they really do is as soon as they see too much volatility in a set of prices, they then tell you that that's extreme volatility and therefore that's high risk. And this tends to evoke a lot of emotion. People get fearful, people worry, and people get concerned. And what happens is that return seems to get pushed into the background. Now, essentially, there's four areas that you can invest in. That's cash, bonds, property, and equities. Now, if you look at all the global surveys that have been undertaken over many, many years, by investing in equities over a long period and allowing the mechanics of compounding to take effect, you will find that equity investments beat most of the other investments, and at the same time there is a bit more volatility, but equities is where you want to be. Now, there's another issue from a human and a practical point of view. You will find that the younger you are, the less you focus on return. Perversely, the older you are, the more you focus on risk. So here we have potentially a fatal flaw, is that if you look at the combination of that, by starting to invest late in life and then becoming fearful, you find that you sell off your equities too early, and that means that you end up with not enough retirement funding. So how do we remove risk from the whole equation? Well, if you just take a big step backwards and understand that over time populations grow, and at the same time what happens is there's a lot of urbanization that takes place. People move to cities. What happens in cities? People receive better education, better skills development, more people have good jobs, and that pool of money grows and grows and grows over time. But what that does is that there's investment, there's consumption, governments spend money, and the pot of money in the world, i.e. gross domestic product, gets bigger and bigger and bigger. So over time, in fact, what growth does is to overtake and overwhelm risk. Whereas if you look at it on a daily basis, you tend to panic. You're worried about what's in front of you. And really, you have to step back and understand that time is a very, very important dynamic, and that will overwhelm risk. Okay, so what we really want investors to do is to be in the market for as long as possible. So what this means is from an early age, you need to start saving and investing. That means that as investors and fund managers, we don't have to panic. We can make the right decisions and build a really good portfolio for you. And in fact, if there are times when the markets pull back, that is a wonderful opportunity to buy into stocks.